Welcome to this Killik Explains video, and welcome to number 4 in my Key Investing Decisions series. And question 4 is essentially, how much risk is it wise to take on? Now, it's a difficult question to answer. It's a crucial question to answer. It's difficult because ultimately the answer is personal to each investor, but let's have a look at some guidelines. So as an investor, we're balancing all the time two key elements. We want to generate the best long-term returns we can, but we also need to manage risk, and we need to manage our perception and our comfort with risk, if you like. So what is risk? And I've mentioned this before, but essentially I see risk coming in really 3 buckets. Price risk is the obvious one. Things go down as well as up, and that's also known as volatility. But that can mask a couple of others. There's liquidity risk. Can I get my money out quickly? And when funds are gated, for example, that is tested. In the property market, certain parts of the market can sometimes get a little bit sticky, a little bit liquid. It's tested again. And sometimes it's just about the length of time it takes to get your money out should you need to. And then the third one is counterparty risk. And I'm thinking here of political risk. It comes in various guises. This thing, geographic risk, some people call it. But that's the risk that actually a counterparty goes bust, takes over your assets in an extreme case, and makes it difficult to remove currency from a particular country, all those kinds of things. Now, how are we going to choose investments? And this is what it comes down to mitigate some of those key risks. And the answer is going to be by a diversified approach, but where do you start and how do you weigh up risk as you go along? Well, level 1, if you like, is asset allocation. That's deciding the big buckets into which your investable wealth is going to sit. Whether those are shares, whether those are bonds, whether those are cash, property, alternatives as they're known, gold, even crypto, not something I recommend, but some people out there like to invest in it. So basically that's the big bucket decision. And then within each asset class, let's take shares, for example, there are then more subtle decisions to take about, am I going to go small cap? Am I going to go mid cap? Am I going to go large cap? Which geographies am I going to go for? I mean, a global approach makes 100% sense in the world we live in today, rather than just say a UK-based approach, but that is a key decision for many investors. So all of these decisions will reflect to a degree your view on, your tolerance for risk. So let's take a look at risk again. Price risk, what is that? It's the fact things go down as well as up. Volatility, and that is a fact of investing life. Over the short term, I guarantee, if you're in equities, you will get short-term dips, and sometimes they can be quite savage, but they shouldn't matter. Because remember, with equity investing, what we're trying to do is squeeze the lemon of long-term returns. And to do that, we need to stay invested. I've covered this in other videos. We need to not panic sell. We need to not be reading media headlines every 5 minutes. We need to be not switching on apps and dumping things just because we can. So really, riding volatility, managing volatility is about proper planning. It's about getting that 3-bucket approach I've talked about in other videos correct. Emergency funds, foreseeable calls on capital, lifetime savings. And then it's about having the right mindset. I am not going to panic sell. I am not going to become a forced seller. In other words, I'm going to manage liquidity risk so I don't put myself in a position where I have to dump something which is doing well simply to raise the money, and so on. And I've done a lot of videos on how you get the right investing mindset. And if you don't have it, frankly, better to hand your money over to someone who does, I would argue. Now, what is your personal risk tolerance? I mean, I haven't really answered that question, and it's a difficult one to answer. It depends who you are. Some people are naturally more nervous than others. It depends on your time horizon. Do you need the money back within 5 years because you're about to leave work, for example, or you've just got to buy something? All right. What assets do you have available to you? So if I'm looking at an equity basket, for example, is this something that can be passed through multiple generations, sheltered within a SIP, for argument's sake, or is it a more fundamental part of what you need for day-to-day living? How much knowledge and experience do you have? Some people are more comfortable with the more esoteric investments than others, or some people are more comfortable DIY investing than others will ever be, if you like. So all of these factors need to be melded together to build a picture as to what your risk tolerance is, and then that needs to be managed. I mean, at the end of the day, if you're investing for, say, a grandchild, they should be taking a bit of investment risk. They've got the opportunity to take advantage of compound growth over decades in a way that someone who's maybe approaching life after work perhaps doesn't. So a good advisor will, and it can seem a bit painful, try and find out a lot of information about who you are, what your natural tolerance for risk is, and so on, what other assets you've got, what the financial picture looks like. They will test suitability. They won't just launch products at you because they can. And they will be good communicators and regular communicators. They'll be there ready to answer questions and to kind of reassure and to take account of changing circumstances as life moves through inevitably the phases where we get married, have kids, buy properties, want to give up work, and so on. And all of that needs to be put into the mix. And of course it means that your risk tolerance will change over time, and that's perfectly natural, but something that needs to be built into your investment approach. Now, lots covered there in this final video in my 4-part series. So for more information on any of the technical topics I've mentioned, killik.com/learn. There are lots of tabs on this side of the first screen, a shares tab, for example, an investing principles tab. You could start there. There's also my guides spell out some of the approach I've mentioned, the 3 buckets approach, the front of any of these guides, and these are sort of lifestyle pivot point guides, if you like, and those are editor@killik.com. They're called how-to guides. And then to read about some of this stuff in context from some of our experts, Confident is the cover right there, the slightly bigger publication. And again, for a copy of that, editor@killik.com.